Good afternoon and welcome to BizTech Asian Midday Market Watch. I'm Samantha Voon, and let's start by taking a look at the summary of market actions today. So in the US, overnight the markets were slammed by profit takings even as soft US inflation data ramped up optimism over interest rate cuts. We see the S&P 500 drop from its records as investors move away from the major tech winners such as Nvidia and Meta platforms. The overall market index fell by 0.88%, stepping back from its recent peak earlier today. The Nasdaq Composite also decreased by 1.95% after reaching a new high, with Nvidia's over 5% dip weighing it down. Conversely, we see the Dow Jones Industrial Average with a modest 0.08% increase. In China, the Hong Kong outperformed due to bargain buying. However, major Chinese tech stock didn't experience the same weakness as their global counterparts, benefiting from lower sector valuations that attracted bargain hunters. Top Chinese tech companies such as Baidu, Alibaba, and Tencent each rose by 2%, and this helped contribute the 2% rally in the Hang Seng Index, which also moved away from recent low points. Compared to other markets, we see the Chinese market show more resilient, with both the Shanghai Shenzhen CSI 300 and the Shanghai Composite Index staying relatively stable today. Over in Australia, the ASX 200 exceed other Asian markets by climbing 0.9% to hit a new peak at 7,969.10 points. While tech stocks have limited its presence in this index, sectors like mining and industrial drove this surge. In India, we have the Nifty 50 suggests a stable start as increase in industrial and consumer shares look to offset declines in the tech sector. Both the Nifty and the BSE Sensex 30 had reached its all-time highs earlier in the week, driven by ongoing positivity about the Indian economy. Over in Singapore, the STI is up 0.66%, and in Malaysia, KLSE dropped 0.33%. So in Japan, we have the Nikkei 225 experience a 1.97% decline, and for the Topix index, we also see a decrease falling by 0.93%. Over in South Korea, we see the Kospi drop 1.4%, mainly due to SK Hynix experiencing a significant loss over 3%. We also have the TSMC, the largest contract chip manufacturer globally, a leading force behind the recent surge in the tech stock. This TSMC decreased by more than 4% from its peak. So this is all I have for today's market updates. To give insight into markets, we have our guest, Kelvin Wong, Senior Market Analyst at Oanda in Singapore. Kelvin, welcome to the show.
Hi, good afternoon, Samantha, and happy Friday.
Happy Friday. Always good to hear you say that. All right, so let's dive straight into it. We have the US June CPI data, and it showed signs of slowing down. What is its impact on the markets at the moment?
Yeah, for sure. So if you look at the core US CPI data, it's showing clearly signs of deceleration in the month of June. And even the services inflation component that has been pretty much elevated in the last 3 or 4 months has also shown signs of slowdown. So the services inflation component has slipped to 5% in June from 5.2% year-on-year in May and 5.3% in April. So very clearly, 2 consecutive months of slowdown in services inflation as well, that some of the Federal Reserve officials deem it as sticky since the start of this year. So with this very clear signs of services inflation component slowing down, market participants now is actually looking at more or less 100% chance based on the CME Fed Watch 2 inferred from the current Fed funds interest rate futures pricing that the first interest rate cut in the US will come in September. And what's interesting over here is that market tends to be forward-looking. So we do expect after the September interest rate cut, the CME Fed Watch 2 is also looking for another cut in the December FOMC meeting. So more or less, two interest rate cut in the US has more or less been baked into the Fed funds futures interest rate market, as shown by the CME Fed Watch 2. But what's interesting over here is that yesterday's very clear signs of much more, I would say, evidence of inflation slowdown in US has led to a potential start of a interest rate cut cycle going forward into 2025. So based on the current CME Fed Watch 2 data right now is showing, there's also high odds of another 25 basis point cut to come in the January and March in the January meeting next year, the FOMC meeting. Then thereafter, potentially also showing signs of another cut in the 19th of March 2025 FOMC meeting. So with that, very clearly, market is now looking for a potential much more higher odds of a interest rate cut cycle to kickstart in the US rather than a cut, then a pause for a period of time. So that potentially starts to see, from a medium-term perspective, we will start to see a kind of a slowdown in the dollar strength, which is also pretty much positive for those laggards stock indices that start to lag behind, especially if you look at the US major stock indices, which we start to see, yesterday we do have a sell-off in the top performing corner of the US stock market, which is the tech sector, where we see the Nasdaq 100 is down close to 2%. The S&P 500 also underperformed. Why? Because of its heavily weighted by these mega cap technology stocks. But those laggard is underperforming since the start of the year, that is primarily concentrated to the small caps and value-oriented play, is now seeing a much more clearer catch-up due to the fact of what we start to see a much more higher odds of a interest rate cut cycle taking shape in US, where the Dow Jones actually up and the Russell 2000 outperformed yesterday.
Mm-hmm. Let's move over to Singapore for a bit, right? We
Yeah,
see
sure.
a Q2 flash GDP growth that beat expectations. Maybe you can share with us
Sure,
what's your
thank you.
outlook for that.
So if you look at the current flash GDP data, so that's the advanced data released by the Singapore Statistical Board. So it actually beat market expectation both on a quarter-on-quarter basis and on year-on-year basis. So on a year-on-year basis, it came in at 2.9% year-on-year, above what market is expecting at 2.7%, almost on the same momentum on a year-on-year basis. There was 3% that was being recorded in the previous quarter. So what's interesting over here is that even the Q1 numbers has been revised upward as well, from 2.7% to 3% now. So what I could see over here is that there is some signs of green shoots that is spotting out in the Singapore economy, especially this 2.9% year-on-year growth. The flash data for Q2 is being primarily contributed by the manufacturing sector, which has been lagging behind in the previous 3 to 4 quarters. So yes, we do see a bit of services slow down, but not that alarming at this juncture. And what's interesting over here is that the impact on the Singapore stock market has been pretty much remarkable. So if you look at the current STI performance right now, it's actually rallied by, as we are speaking, 0.7%. And at this current level, it's the highest level that is being seen so far in April 2018. And it managed to break above the previous major swing high that is being recorded ex-post pandemic, that is in February 2022. And also in line with this ongoing, we call it potential interest rate cut cycle that is getting more evidence in the US, that could also start to have a positive spillover effect to the Singapore stock market. Why? Because the Singapore stock market is also primarily oriented according to the value-oriented factor, that means heavily weighted by the banks and cyclicals, especially manufacturing. We could also start to see a catch-up play in terms of the rotation into this laggard play as well, being said that because Singapore is heavily weighted to the value factor.
Mm-hmm. Yeah, you mentioned about the banks heavily invested with Singapore, right? So is there any other events to look out for today?
Yes,
Because
precisely.
the Q2 earnings will be out, right? Yeah.
Yes, for the US, especially unofficially, I would say so. So this will be today will be the start of the unofficial start of the US quarterly earnings season. So starting with the major banks first. So for today, we have three major banks to look out for before the start of the 9:30 p.m. official start of the US stock market trading session. So JP Morgan, Wells Fargo, and Citigroup will be reporting. So what's interesting over here is that ahead of their earnings release for today, the sell-side analyst expectation for these three banks has been much more revised slightly downwards in the last few weeks. So given the fact that they are slightly revised on the downwards, and also very interesting that it's been kind of low bought down. So if earnings came in within expectation or managed to beat expectation, that could actually start to see a positive feedback look back into the US banking sector. So if you look at yesterday, the US banking sector ETF actually rose by 3%. Okay, there's this particular banking ETF consists of definitely JP Morgan and Wells Fargo inside as well, indicating to us that there is a clear signs of a healthy rotation from that current I would say that the year-to-date high-flying technology-driven AI-driven play now spilling over to the laggards, which is the banks is one of them, being they are value-oriented. So very investors should be actually paying close attention to number one, the guidance also up from these three banks going forward, given that right now potentially the Fed is much more inclined towards cutting rates rather than hiking them. How does that impact in their loan loss provision? So potentially that could be much reduced, lower risk of bad debts. That could also potentially see an improvement in terms of overall net profit margin as well.
Okay, thank you so much, Kelvin, for your insight.
My pleasure.
So this has been Vista Asian Midday Market Watch. Be sure to keep informed on the latest market updates weekdays at 1 p.m. I'm Samantha Voon, and this video and podcast will be on our website, www.biztech.asia, and our social media platforms. It will also be on our syndication partners' TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.